Hello friends, this is Vijay Bambwani. Welcome to the 70th video on the weekly market outlook. This is probably the only place in the world where you will be served statistical data-based version of the truth. And like I have been warning you in the last couple of weeks, as you can see on the thumbnails of the previous videos, the markets are in for a bumpy ride. We don't believe in softening the blow. When the truth is the truth, it will be served as such. So in this 70th edition of the Weekly Market Outlook, I'm going to tell you what the market is likely to present to you because these are very, very challenging times and volatility is extremely high. And I want to help you navigate through the labyrinthine market that it has become. Now, let's dive right into the market roundup window, which you can see on your screen. And as you can see, the fall was led by the banking space, not surprisingly, because inflation was expected to be higher. Bond yields were screaming. As you can see, the 10-year benchmark bond yield rose to 6.81%, which is why banking took it on the chin. When inflation goes up, the savings rate goes down, and therefore it is expected that banks will be able to garner working capital either at a higher rate of interest, which is what is happening, which is why Bank of Baroda, SBI, HDFC Limited, Bajaj Finance, HDFC Bank, etc. have started raising interest rates. The other noticeable aspect which worries me, and there's going to be a special mention of this in this video itself, is the rising US dollar. It went to a kissing distance of 99 but closed at 98.509 where the US dollar index is concerned, the Dixie. It notched up gains of 2.04%. The USD INR rose 1.02%, which means the Indian rupee fell in percentage terms, half of what the Dixie gained. But like I said, there's a special mention of the currency segment in the Dixie and the bond segment. So do pay special attention to this segment. What the other worry on the market was that crude oil jumped a whopping 25%, natural gas jumped 13%, and consequently, bullion, which is a very, very good proxy for risk appetite or lack of it thereof, jumped as well. Silver notched up gains of 8% and it came to kissing distance of 75,000 rupees per kilogram, and gold notched up gains of 4.5%, jumping to 52,500. I'm going to tell you why the upsides in gold may just extend. By the way, there's an excellent video that I have recorded for Equitymaster as to why selling by Russians to raise cash, selling gold by Russians to raise cash may not necessarily collapse gold prices. The hyperlink to that video is in the description below this video itself. So, the NSE market capitalization fell by 1.42%. Remember, last week we crossed the Rubicon of 4% declines, and I've told you earlier, week-on-week declines of more than 4% for 2 or 3 trading weeks or more can lead to significant downsides in the market. Mercifully, that didn't happen. The MWPL rose, which is very natural, which is routine after an expiry. Traders do start to raise their exposure levels after expiry. And the newly included overseas cues by way of the Dow Jones, Nasdaq, and the Standard & Poor's 500 index that I have started covering. Remember last week I told you the Nasdaq has exhibited a death cross where the 50-day moving average has closed below its 200-day moving average, and that's a sign of bearishness. The Dow Jones is headed there. It's not yet there, but it's headed there. And we all know what can happen if the US market was to basically fall sharply. So these are concerns that would be faced by the markets. Coming up on your screen is the MWPL chart. As you can see, on expiry day, we went to 18.42%. And today, on Friday evening, we are at 22.8%. But gone are the days when MWPL used to peak out at 32, 33, or even 34%. That happened in November. So December, January, February, we've seen progressively MWPL falling, which is a 2 Marshmallow benchmark. These are traders who create positions, sit on them overnight, write out checks for span margin and mark-to-market margin and say, okay, I'm convinced, I'll hold on. These guys are not as gung-ho as they used to be. The 2 Marshmallow theory is covered in another video. The hyperlink to that is also in the description below this video. Let's now see the stock and index futures turnover over the last 20 days. What you are seeing are 3 concurrent futures series, which is March, April, and May. What you are seeing is a very sharp decline in individual stock futures after Thursday, which of course was pretty natural. Thursday was the weekly expiry, and therefore a lot of hedging and unwinding of trades were happening. But the decline is fairly precipitous. And where the index futures are concerned, we are seeing a week-on-week rally in the volumes, which is telling me that the 1 Marshmallow traders, the intraday traders, are choosing to stick to the lesser volatile indices, because intraday volatility in indices is between 1.25% to 2%, whereas intraday volatility in stocks is 3% or higher, ballpark. So there is risk aversion. Traders are shying away from excessive risk, which tells me that the markets are extremely nervous. Let's now go to the basis analysis. What is the basis? It is the premium enjoyed by the future over spot. Now, week on week, there may have been a rise in basis, but it is nowhere close to what it used to be earlier. Why is it happening? Because people are selling at higher levels. I told you in the last 2 or 3 videos, you must be extremely careful in those weeks where the basis is inverted or negative, which means the future is trading at a discount to cash. If it happens for more than 2 or 3 trading sessions in a week, that means the 2 Marshmallow guys are basically fleeing with nervousness. So mercifully, last week, which was shortened by a holiday, did not see too much by way of inversion. So from that front, of course, we are relatively better off. I've started including the advanced decline ratio of the National Stock Exchange, the NSE. And in spite of the fact that you had only 4 trading sessions, what you are seeing is that out of 4 trading sessions, 2 saw more advances compared to declines, and the other 2 saw more declines as compared to advances. Friday, of course, saw a low point of the week where the advanced decline ratio has collapsed to 0.36. All right, which means for every 360 stocks rising, there are 1,000 stocks falling. Now, that's not exactly very good news. Keep watching this, because this is again another benchmark or a proxy of risk appetite. Now for the impetus, the in-house exclusive oscillator, you will not find anywhere else in the public domain. And this is something that you have trusted, you've banked on, you've given me so much of positive feedback about. And look at the way the Banknifty impetus is rising on all 4 trading sessions of the week. The kind of slope of the Banknifty is far sharper. Of course, the Nifty 50 has also been climbing somewhat, and Friday's impetus of the Nifty is also higher. But it is clearly the Banknifty impetus which steals the thunder. And remember, the impetus has come on falling values, index values, which means that the 1 and 2 Marshmallow traders are preferring to sit on the side of sellers, not buyers, sellers. That's another red flag in this video that I've made so far. Now let's go to the latest in-house exclusive indicator, which again, I assure you, you will not find anywhere in the public domain. The LWTD oscillator, the indicator, which has been warning us whether the markets will fall or they will resist the fall, which I told you on my social media. As a matter of fact, if you connect with me on my social media accounts on these contact coordinates, I cover everything, the MWPL, the day-on-day basis, the LWTD oscillator, the advanced decline ratios, as you can see on your screen. So you can keep updating yourself and stay ahead of the crowds, which is what my video is all about. It is to stay ahead of the crowd by a few miles, not just a few steps. Now, so far, out of the 4 trading sessions, till Thursday, the MWPL was telling me, the LWTD, sorry, I beg your pardon, the LWTD was telling me that even though the Nifty was falling, the broader markets were expected to resist very big declines. But on Friday, not only has the Nifty fallen off sharply, but the LWTD has gone into negative zone. So it is now inverted. How do you read this excellent oscillator? There is a hyperlink to that video in the description below this video, as well as in the end screen. You will see 2 hyperlinks to my videos where you can learn my in-house oscillators. Now the reading of LWTD is wait. Wait as in come down. If you want to be optimistic, you can say it's a drag, but I would categorize it as wait. So I think barring any positive news flow of peace in Ukraine versus Russia war, I think the markets on Monday are also likely to be nervous. Let's now take the footprint of the 4 kind of market participants out here. The FIIs are something that I start off with. They have raised their net long positions in individual stock futures marginally, but they have started pressing shorts in the Nifty, which you can say is a hedge trade. So while they are going long on individual stock futures, they are shorting the index, both the Nifty and the Banknifty. Where DIIs are concerned, they've covered their shorts marginally in the index futures, but there has been a significant increase in shorts in individual stock futures, which tells you that the big boys are actually hedging their bets. Let's now come to prop traders. Now, the last 2 categories always interest me the most because they tell me the broader move of the markets where retail and the specialists are thinking. So, where the prop traders are concerned, they've very clearly gone net short into the index futures. As you can see on your screen, they were net long last week, but they are net short now. And where individual stock futures are concerned, while they may have lifted their index, their individual stock future exposure, but the fact remains that week on week, their exposure is lower. So the specialists are not really very gung-ho. Let's now go to the retail guys who have been doing all the heavy lifting in the market where the rally is concerned. And what are they doing? They are moving out of individual stock futures longs, which have come down and come down by a big margin from 10,95,834 lots. They are now 10,85,000. That's 10,000 futures, 10,000 lots lower, which may not be much, but do remember, but after expiry, this exposure normally is supposed to go up as per empirical evidence. It is coming down. And what are they doing? They are actually going long on index futures. Why? Like I told you earlier, The one Marshmallow guys are focusing on index futures. Remember, in the turnover of the index versus stock futures. That's because their risk appetite is lower. They are playing safe. Now that tells you a lot. Friends, I now go to the bond market, which is extremely important both from the broader market perspective and specifically for Banknifty traders and those traders who basically rely a lot on banking stocks for their day trades. What you are seeing is that the Indian benchmark bond yield, after kissing 6.9%, has settled at 6.81%. Now that tells you that the market is expecting higher inflation, which is but natural. Fuel prices have jumped sizably in the last 1 week alone, thanks to the Ukraine war and fears of disruption of supplies. And even natural gas prices have jumped. And we all know that after the UP elections are over, petrol and diesel prices, even LPG prices, might be hiked almost immediately. So the bond market is saying, hey, we think inflation is going to go up, and concurrently interest rates need to go up, which is something that PSU banks are already telling you, as SBI, BOB, HDFC Bank, HDFC Limited, etc. have started basically raising their interest rates. So the cost of funds is going to go up. There's been an impact on one aspect of the market that you need to be particularly very, very careful about. And that is the USD INR. The USD INR is something that impacts all of us. Normally, a lot of people think that the individual stock index, the benchmark indices of the BSE or the NSE, tell us everything about the economy that we need to know. This is a fallacy. Why is it a fallacy? Because stock market investments are in single digits in percentage terms of Indians participating in the markets. What is more relevant to almost all Indians, or not almost all, actually all Indians, is the currency peg. Why? Because the buying power of the rupee impacts everyone, every single Indian citizen, man, woman, or child. And the Indian rupee is barely 1% away from its all-time low versus the dollar, as you can see on a monthly chart on your screen. So the buying power of the rupee might ease against the dollar, and that results in what we call imported inflation. Everything that you import, especially fuels, and fuels are multiplier commodities. If fuel prices go up, everything from grains, eggs, meats, vegetables, fruits, etc., everything start to go up. And anything that is import dependent, electronics, pharmaceuticals, etc., will start to become more expensive, and you will start to import inflation. Now, this is the aspect that unfortunately is being missed out in the broader public debate. Now, this is something that you need to watch out extremely carefully. Should the USD INR cross another round number, which is 77, you're basically looking at higher amount of distress in the market. Friends, I have continuously told you that you must invest in fixed income, because that will A, take your money out of harm's way when stock markets fall, and B, give you some amount of returns, even though you might feel that the returns are far compressed as they used to be a couple of years ago, but you're still getting net positive yields from the fixed income market as compared to negative returns from equity markets. So keep laddering. As I keep telling you, keep laddering sovereign investments, fixed investments, not just sovereign bonds. When I say sovereign investments, the canvas is much more bigger. You're including everything. The post office, I've been telling you a lot about post office schemes, about post office deposits, about PPF, about sovereign bonds, about electricity board bonds, and your yield is far above a bank FD rate, as well as 100% guarantee of the central government as compared to 5 lakh rupee insurance on a bank fixed deposit. So please keep some money out of harm's way from equities and do ladder in the fixed income market, especially the sovereign debt market. Friends, the debt segment done. I now come to the US dollar index, the Dixie. As you can see, it's running up along a bullish trend line since the last 8 or 9 months. It gained 2.04% on a week-on-week basis, and what we have seen that it's crossed another round figure of 98 and closed above it. Can it go towards 100? Over the next couple of weeks, it might become a possibility, which means all emerging markets, including India, will feel the heat of a strong dollar. Our foreign debt, our borrowings will become more expensive. Even the Indian government borrowing from overseas market runs a risk of higher interest payouts. So this is extremely critical, both from corporate point of view who've borrowed from overseas markets, as well as the sovereign point of view. So what you are seeing is that the price is running away from its 25-day exponential moving average, which is a proxy for 1 month long holding on cost of an average bull. And the short-term outlook is very, very comfortably bullish. And we are basically seeing optimism in the US dollar index. There's a flight to safety. The more there is bad news on war, the more there is defensive buying in the US dollar. Now, when you come to the the weekly chart of the US dollar index, you will realize that not only is the price running away from the bullish trend line, but there is a big, strong green candle in the last week. Now, this is something many technical analysts call a power candle because it is far bigger than its recent candles. That means a big, sharp up move has taken place. So even if the next week is likely to may see a decline, that decline will be very muted because a lot of energy has gone into pushing the price this high. Now, last week I advocated a range between 97.75 and 95.40, which was overcome on the upside because the peak was 98.94. Well, that basically raises the fear factor even more because, like I said, emerging market economies, including India, will feel the heat. So the next week, I expect a range between 99.80 on the upside and 97.25 on the downside. Friends, the dollar index done, I now move to the Banknifty, which took the brunt of the selling and fell 5.5% on a week-on-week basis. And as you can see on the daily chart on your screen, out of 4 trading sessions, the Bank Nifty fell on all 4. And the fall on Thursday was a power candle, a big red candle. The fall on Friday, of course, was caused by a gap down, so the candle appears smaller, but the wick or the shadows are big. Now the price is comfortably below its 25-day exponential moving average, which represents 1 month of holding on cost of an average bull. And unfortunately, the 25-day exponential moving average itself is falling. Now this is a situation where the bull is not even recovering his cost of carry, his rolling over and cost of carry from one derivative cycle to the other. So if you unfortunately rolled over your long positions from Jan to Feb and Feb to March, you're in severe amount of pressure because you're paying mark to market and your cost of acquisition of long positions is going up every time you roll over your positions. And as you can see on your screen, there is a trend line which is horizontal in nature right from June 2021, slightly below 34,000 levels, which has not been violated since that day in June. We now run a risk of falling to a 7.5-month low, and if we fall below that, the bulls will simply start to surrender their long positions and the Bank Nifty might just start crumbling. That's a serious threat to the Bank Nifty. Looking at the weekly chart on your screen, you can see a power candle. Now that candle is a huge body compared to the previous 3 or 4 trading candles. And what we can see is that the Bank Nifty has been falling on all 4 weeks in the last trailing month. That tells you that the bulls are simply on the ropes. They are taking a thrashing from the bears. And here also, the 25-week exponential moving average, which represents 6-month holding on cost of a bull, is turning lower. It's just the beginning. It's turning lower. But this is the second consecutive week that the closing is below its average. Now that tells you that this is the first serious major correction after the bull market started in end of March 2020. So a lot of myths, a lot of preconceived notions, oh, the market can only go higher. If we buy in the morning and sell in the afternoon, or maybe tomorrow, we are going to notch up trading profits. Those kind of misconceptions are going to be tested or maybe even smashed. So in the week before last, I saw the Bank Nifty at number 3 on the most volatile list on the NSE derivative segment. Last week, now this is extremely important, it jumped to number 1. It's the most volatile derivatives counter on the NSE derivative space. And it's an index. It's not supposed to be so volatile. Now, this kind of volatility often tells me that either an explosive fall can come in place, or there will be a great deal of tug of war between bulls and bears who will basically try to see who wins and prevail upon the other. In either case, the challenge to a day trader simply went up a couple of notches. So be extremely careful out here. Last week, I advocated a range between 38,200 on the upside and 34,500 on the downside, which was violated to a small extent because we saw a low of 34,408. So I was off by 92 points. But do remember, this is wartime and volatility is extremely high. The Bank Nifty is number 1 in the volatility rankings. The coming week is likely to see an expected range between 36,200 on the upside and 32,500 on the downside. Note, the range has fallen by 2,000 points as compared to the previous week's expected range. Now, the Bank Nifty is slowly but surely settling lower. It's seeking equilibrium lower and lower. From a statistical point of view, this is not good news at all. Friends, the Bank Nifty done, I come to the Nifty 50, which is the most liquid, low impact cost derivative traded instrument on the NSE trading platform. And as you can see on your screen, this index has stayed comfortably below the triangle pattern that I have plotted by 2 trend lines. And out of the 4 trading sessions last week, it fell on 3 out of 4 trading sessions. The price is comfortably below its 25-day exponential moving average, which itself, unfortunately for the bulls, is trending downwards. Here again, the bull is under severe amount of pressure. He is not able to recover his rollover costs. And if you have bought the Nifty 50 at any time around expiry of January series, you've incurred rollover costs from Jan to Feb to March, you're basically underwater. Now, the price staying below its 25-day exponential moving average, which is a monthly average, is always bad news for the bulls. But this is significant bad news because a round number of 16,000, if it is violated, will simply unleash a wave of program algo selling. Now, that is something you have to be extremely careful about in the week ahead. Coming to the weekly chart of the Nifty 50, we see that the index is showing a semblance of an inverted hammer. So the price opened lower. It tried to rally, but it failed and closed lower. It's not a power candle, which is basically confirmed by the fact that the impetus of the Nifty was not as steep as the Bank Nifty. Now put all these things together, tie all the loose ends together, and you'll start to see a pattern emerge. A jigsaw pieces of the puzzle are falling together to form a picture. See how the impetus warned us, how the LWTD of the Nifty warned us, and now you correlate it with the price and you suddenly start to see that, hey, Vijay was talking sense. Statistics do help make better traders. So, which is what I'm helping you out with in my videos. Now, here again, the 25-week exponential moving average on the weekly chart is turning lower. Now, this is a 6-month holding on cost of a bull. And this is, like I said, the first severe correction, first serious correction after the bull market started in end of March 2020, which is what the chart is covering, the weekly chart is covering. This is the first time a double top is formed and the previous bottom runs the risk of being violated. This is a very, very challenging time, my friends. Do not assume that going long is the only way forward for you. As a matter of fact, I made a video a couple of weeks ago and I told you there is opportunity in adversity. Going short could be a lot more profitable for savvy traders, only for very savvy traders. And I remember I gave you a couple of sectors which would suffer the most out of the decline. And I told you these are the sector whose stocks you should focus on shorting intraday. The hyperlink to that video will appear in the description below this video itself. So you can catch up on that and refresh your memory. Now, in the week before last, the Nifty was at number 8 on the most volatile list on the NSE. It fell one notch to number 9. Why is it? Is it that the Nifty's volatility has fallen? Not really. It's just that the volatility of individual stocks has risen faster than the Nifty. So there are other counters that have overshadowed the Nifty's volatility. But volatility remains extremely high. So be extremely careful out there, dear friends. Last week, I advocated a range between 17,275 on the upside and 16,000 on the downside, which held perfectly well. And the coming week, I expect an estimated range between 16,875 on the upside and 15,600 on the downside. Can the ranges of the Nifty and the Bank Nifty be cast in stone and we would expect them to hold come what may? I think so. It would be a mistake to assume this. This would be a very expensive presumption because these are war times. Geopolitics can mean that the market can turn at the turn. Markets can turn at the turn of a dime. One adverse news flow, and you can see sentiments turn either ways, right? So be extremely careful out there. And I keep talking about the Jensen's measure, the Traynor ratio, and Kelly's criteria. All these are basically telling me that this is not exactly a very good time to be aggressive on the long side. At least don't take leverage long positions recklessly. And do keep connected with me, stay connected with me on social media because I keep updating all these metrics on my social media pages at the end of the day so you can stay updated and monitor for yourself as to what needs to be done. Friends, the indices done. I now come to the most popular segment of this video wherein I give you 5 stocks which are high impetus, high beta, where you take small exposure, wait for large price moves, and 5 stocks, low impetus, low beta, where you take large exposure, wait for small price moves. Different traders, different mindsets, attitudes and aptitudes, so your strategies differ. I'm trying to help both categories of traders. So here goes. The high beta, high impetus list is led by Hindalco. No surprises, metal stock, metals have been flying. Hindalco at number 1, Power Grid at number 2, Coal India at number 3, Maruti at number 4, and Biocon at number 5. The low beta, low impetus stock list is led by Manappuram Finance, PEL, Syngene, FSL, and Aurobindo Pharma. Friends, a word of caution here. This list is dynamic. It keeps changing hour to hour, day to day, because volatility can compress or rise hour to hour. So stay connected with me. I'll keep updating you and provide hand-holding. Very easy to understand statistical data. Even a fourth standard school kid will be able to understand that. No rocket science. Don't get intimidated. Friends, before I bid goodbye to you in this video, I request you to click like on this video, subscribe to my YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts about fresh videos being put about here. In the comment section, do let us know what you think of our work. I'm going to be adding a lot more oscillators and indicators for you, so please do watch out for the third module of IBEX should be completed by 31st March. As we step into the fourth, we will start sharing with you indicators that are thrown up by the second module. So far, what you have seen are indicators in the first module. We'll basically start sharing the second module indicators. Why the lag? Because we are testing them with our own money, profits, losses, what comes. We are testing on ourselves before risking your money on the line. And yes, all the indicators that I share with you are always going to be free. Right? So in the comment section, do let me know what you think of our work, and please help us reach out to fellow like-minded investors and traders who prefer data-backed solid analysis in the public domain by sharing our video with your family and friends, and do circulate them in your groups. If you wish to be connected with me on WhatsApp, the link is up there. My mobile number is up there. We provide you with WhatsApp broadcasts. You want to be added to a broadcast list, you're more than welcome. Refer your friends as well. Just send us a message giving your full name and your mail ID, and we'll get you going right away. Thanks for your patience, my friends. I wish you have a very, very safe and profitable week up ahead till we meet again in my next weekly video. This is Vijay Bambwani signing off for now. Do take very good care of your trades and your health. Bye-bye for now.